I would say it's a different company today in a different situation, a different fact pattern, and therefore a different investment outlook than it's been. And so therefore it's really radically changed. And therefore there's also the opportunity, we think, that people think they know what it is, and they don't really understand what the business is and how things are changing. And there's also, it is currently in the process of a transformational merger. Saipem 7, a long-standing competitor, and Subsea 7 have agreed to merger terms. And so that is the most recent culmination of the radical adjustment that's happened to this business over the 30 years we followed it. So again, people may tune out if they say Subsea 7. I've heard Bob talk about that in the past. I would ask you to bear with me and listen to what I have to say, because I think the investment thesis today, based on the price of the security, is one different than it's been in the past. And there's a phrase that says you can't step twice in the same river because the river changes. Here's a picture we have of New York 100 plus years ago and more recently, and New York has changed. So things change. And businesses change potentially much quicker than that. And so that's what's happened. This business is structurally transformed from where it was when I first invested in it 30 years ago. So stay with me to listen to why. The business itself, the historical business, is to engineer, procure equipment, install offshore oil fields, oil and gas fields. And so what's happened over time is that businesses continue to advance. Technology really has been significant. It's different today than it has been. The business itself, in addition, what's really happened is there been structural changes in terms of Subsea 7 was a company that would bid on contracts to do engineering installation work on an offshore field, as opposed to today. There's been an extended amount of time where that process has actually changed, and their role is much different than it has been. And the starting business of the oil and gas business has meant that they install large pieces of equipment offshore with large floating vessels. That business, of course, 15 years ago identified a new use of that capability, and that was to install offshore wind, offshore fixed wind. And so therefore, Subsea 7's Seaway 7 segment has been a participant in this business for 15 years and has continued to build out that business. And they're one of the larger contractors to do the installation of offshore wind. So that's a significant revenue generator to Subsea 7 today, and we think will continue to grow. And so that changes somewhat the dynamic. In addition, there are other technologies that are renewable, new energy. And those are carbon sequestration is something that they've got one of the first projects they were sanctioned to do in Norway. They're doing that. They're doing, they're working on and have been working on for over 10 years, floating wind, right? Because there are many parts of the world where fixed wind doesn't work because you don't have shallow enough waters. So therefore, there's a much larger opportunity set if you could do floating wind. And they've been working on that. Then there's also different hydrogen applications that they also have capabilities in, and expertise and technology. So again, we're looking for industries that go through cycles because the cycles therefore really create opportunities for consolidation. And that's what's happened here. There's been multiple rounds of difficult times, consolidation. And what's really happened is the current Subsea 7, soon to be merged with Saipem, to be the largest in the industry, has gone through many iterations. And many of those iterations were at times where they then were opportunistic and were able to buy businesses for far less than what they're worth. So exactly the kind of template. And a critical factor in why that happens is we do follow this kind of back through the DSD and offshore, because that's when Christian Siem really got involved with this business. And so like many of us who are value investors, right, one of the things we look for is an owner operator, right? Someone who's involved with the capital allocation, especially in a cyclical business, especially in a business that has capital requirements. So all of those things, you want someone who understands the cost of capital, and you want someone who is aligned with the shareholders to think about how to optimize the values that you create. So Christian Siem's involvement has been the critical factor that has, and he is the architect of the current merger and the company, and part of our excitement for the business. The business most recent downturn started in 2014. And it was interesting because 2014, the business slowed down in terms of new awards. And that was with an oil price of $120 a barrel. And the reason was because in 2014, the contracts and the cost to develop offshore field had grown astronomically and they were not economic. And that's for a number of different things. And a lot of that had to do with the design and the execution and the structuring for these contracts. So in 2014, there was a significant reduction in new awards, even though oil prices were high. Now, of course, what happens is at the end of 2014 is that OPEC responds to the continuing growth of 1 million barrels a day onshore US, and therefore adjusts the price of oil and therefore substantially changes the dynamics for an extended amount of time. And in that process, the offshore business substantially reduced. So that's what you have. You have a lot of people in this business. And I want to point out one or two. So one of the companies in the regional player category is a company called Siona. The reason I'm going to mention Siona is that there could be a perception that this is an asset-based business, that you need what are called enabling assets. And if you have those, then that you're competitive. And that means you could build another asset. And if you build an asset, you can get into the business. And so therefore, where's the barrier to entry? Siona, we think to us, highlights the fact that there's a barrier to entry because it's the engineering and it's the expertise and the installation, the track record that are critical. So Siona went out and built a brand new vessel, state of the art, hired the senior management from a number of the other competitors. So you had top management and you had vessels. So you had what you thought was something to make you competitive. In the meantime, when Siona would show up and bid on a contract for one of the majors, they would say, okay, so where's your project execution portfolio? They said, well, we don't have one of those. And so every oil company would say, I'm not awarding a contract to you. I don't know if you can execute on it. So therefore, we think that that highlights, even then, that it's the experience in terms of the installation, it's the engineering knowledge in terms of how to do an installation in 3,000 feet of water, how to execute a multi-billion-dollar project is the critical differentiator in the barrier to entry. And so that happened in 2014. That company never got a piece of work. So over time, we've had continued consolidation. And again, in the downturn, a number of times, Subsea 7 opportunistically bought one of those competitors that went out of business and bought their assets for far less than what it would cost. In one case, they bought a business for $800 million and it had a portfolio of business that was $1 billion that therefore had substantial profits in it. And it had a spool base that you couldn't get. And it's the best one in the Gulf of Mexico. So therefore, continue to acquire assets opportunistically and at discounted prices. Here's a very busy slide. I apologize how busy it is. What I really am driving at here is that this business has changed. Today, the two preeminent service providers are TechnipFMC, which is the result of a combination of a French company, Technip, that did installation like Subsea 7, and FMC, the premier subsea service equipment manufacturer. So the combination of those businesses, and of course, they were very aggressive in saying, we have a unique business model because we can do everything. We're a one-stop shop. You come to us, we can sell you the piece of equipment and we can do the installation. And we also have what are called flexible pipes. And so therefore we can do some of the umbilicals, the connections in the pipes, the risers, do all of those things. But what's happened over time is they've continued to advance that idea. At the same time, in response to that, Schlumberger, who had bought Cameron, who was the number 2 subsurface equipment manufacturer, therefore partnered with Subsea 7 as the service provider to say, we can offer a fully integrated solution just like TechnipFMC. So that combination, that Subsea alliance, has been a critical factor. And those two companies continue to advance the idea that they now go to oil companies and say, if you got a project, you bring us the project. And now they do the pre-feed and the feed studies, right? So those are engineering studies that are normally done, historically done by third-party feed and pre-feed study people who would then design a project and then bring it to the equipment companies and bring it to the installation companies and say, tell me what it's going to cost. Here's how I want to develop the field. What's happened in the last 10 years is Woolley Parsons Wood Group who did the pre-feed and pre-feed studies have largely been disintermediated from that business. The major oil companies, many of the major oil companies have had substantial cutbacks in over time and have had people who retire, and that's part of their cutback, right? They had early retirement. So the people at the company who used to design the project, many of them are not at those companies today. So there's a dearth of kind of expertise in how to do this. In the meantime, TechnipFMC and Subsea 7 have been doing this for 40 years. And the amount of work that they've done and the engineering that they've done, they have capabilities that are significantly greater than most oil companies. And so therefore the oil companies have identified the idea of, instead of me going through this multiple steps with all these cooks in the kitchen, let me do it directly with one person, and with the advantage that you get standardization, you get someone to really think about the structure and to optimize that. And therefore, that's a critical piece, is why this business of offshore today is economic, and why discoveries say this is economic at $40, $35, $30. So the economics on a lot of these things continue to come down because you've done a different engineering design. And that's the new offerings that TechnipFMC and Subsea 7 and Schlumberger do through their alliance. So therefore, more and more businesses are gravitating to them. And that means they get the business as the preeminent service provider, and it's not a competitive bid process. In the meantime, not only have they reduced costs from doing this, and there's many companies, oil and gas companies, you look through, they will tell you this is the model that they follow because it's a better model that ends up with a clear design that's worked, and therefore the costs have been reduced. In addition, there are technologies that each one of these companies have that make them the better company to execute on certain things because they can substantially reduce the cost of the field. So this is a change to the economics of the business, how TechnipFMC and Subsea 7's business is today, and therefore make them clearly preferred providers, and in a much less competitive situation in terms of pricing when the contracts were awarded. In the meantime, what has happened is, for part of those reasons that the economics have gotten better for offshore, oil companies have recognized that this is part of the business in terms of their oil and gas, where they want to be and where they're still expending money and where there are growth opportunities for them. And so here's a chart that shows project backlog, the pipeline of new things to be bid on back in 2022. What's happened is the continued economic success of offshore meant it's really taken a much larger place and continued to grow. And you've seen that in many of the other service companies. So the offshore drillers are the poster child for this business, and 2-3 years ago had phenomenal runs because the business reactivated, business picked up, and so therefore it was economic activity picked up again, and so therefore that drove a lot of investment and some attention to this business. Of course, what's happened is the growth has slowed down and the stocks have petered out, and therefore that also drives public market perceptions, because the drillers are the most visible part of this business and yet have a very different business model than this company does, or other service providers in the offshore business. Here's 2 slides that show Subsea 7 and Technip's pipeline of projects they think in the next 2 years get awarded. And so therefore there are many more names. The size of the contracts are larger. In addition, what's happened is the addressable market continues to increase, because 15 years ago, it was really oil prospects and projects were economic and gas projects were much more troubled. And today, gas projects around the world have become, because of the growing use of LNG, continue to grow out. So therefore, a number of these are natural gas projects that can get developed. What also is happening is the geographies are increasing. And of course, the poster child for that is, Guyana is a place that Exxon made a discovery 5-6 years ago, and it's grown significantly, the production that they have in Guyana. Suriname is nearby and has attracted attention. But there are other geographies now that also have identified projects that are economic. Turkey is one with a really interesting one in the Black Sea. It's grown a lot in the last couple of years. Subsea 7 and Schlumberger have been critical with fast tracking that project and really great economic returns. In addition, what also is on a number of these projects, there's a thing called tiebacks. So again, increasing the addressable market. So there's a larger and larger universe of existing platforms what happens now is if you can identify within 10 miles a field that wouldn't be economic on its own because the reserves aren't large enough. However, from 10 miles, you can easily tie it back into the existing platform. That platform was built to produce 150,000 barrels a day, and today is producing only 50,000 barrels a day due to the natural decline of the reserves that it originally developed. You've got all this spare capacity. So therefore, in a short period of time, with a limited amount of money and none of this infrastructure for new floating production platforms, you can tie back into those. So tiebacks are an increasing amount of business that this business is available to them. And recently, there was an award of a contract by Petrobras, which actually took a couple of these fields and aggregated them. And the size of the award was equal to a large greenfield project, $1.5 billion. So there's more and more projects that are also filling in because you've got more infrastructure in addition to new projects, new geographies. Namibia, Mozambique are examples of other parts of the world where there have been discoveries that are now being developed. And so therefore, we think the white space continues to grow. And here's the order backlog for both of the businesses. And the order backlog is interesting because that reminds me of another point. So the earnings of Subsea 7 are back-end loaded. And so what do I mean by that? The major contracts, a new greenfield development, means that most of the work is actually done probably the third year of the contract. So they design, they engineer, they procure, and then they actually go to the field and start to do the installation. So the revenue stream that they report in the earlier years is lower, and then the bulk of the revenues are going to be in the later years. What also ends up happening is over this period of time, contracts 5 years ago in a more competitive environment had different margins associated with those businesses. And so therefore, the profitability of historical business is not what it is for the current market where there's limited availability of equipment and therefore there's pricing power. A year ago, Subsea 7 made the comment on one of the contracts. They said every contract they think is a price discovery process. So therefore, prices continue to move. But what that means is the earnings you're reporting today are based on the contracts you were awarded 3 years ago in a more competitive environment with tighter pricing. What also, of course, is happening is as the business picks up and there's more work to do, there's optimizations of the equipment that you have. So therefore, utilizations improve. So therefore, your margins improve. So even if you bid it, you thought the margin might be X, you were bidding that in an environment where there probably was excess capacity. As the capacity gets tighter, and therefore you're doing more work, you're generating more revenues, therefore there's more profit margin. So there's a lot of things that positively favor the continued growth in earnings as what plays out as the current existing environment. In the meantime, that the Saipem earlier this year said, or toward the end of last year said, for the next 2 years, every piece of enabling equipment that we have, the big assets, is already booked. And so we don't have availability. And so that supply-demand structure is one that is going to show up as earnings continue to get executed on contracts that are being awarded today. So the merger itself, we think also is transformational, right? So the largest fleet of equipment is Subsea 7. The second largest fleet is Saipem. So the number 1 and number 2 companies are combining their fleets together. And there are many advantages from that combination. So here's the different segments that they're in, and each has different strengths. So therefore, you see in SURF, Saipem does some of that, but Subsea 7 is the preeminent provider in that business. And so the complementary part of that is really a positive from, but and so that will drive, we think, increasing profitability. But more important than that is this. Here's a chart that is kind of messy, but what it actually shows is there's many different types of equipment, and those different types of equipment are expert at different processes for different fields. So therefore, if you do bid on a contract and you don't have one of your J-lays available and you bid it for an S-lay, because you could still figure out how to have it operate, and so it has to work for a few more days, doesn't do it exactly the same way, but you could still bid it and have bid and won that contract. Now, suddenly, if you merge the two businesses together and the other company has a J-lay that it can substitute in for your S-lay. So it really is the optimization of equipment, because different things, different pieces of equipment have different capacities and capabilities and execute differently. So what you really do is you increase with the same vessel fleets combined, you increase the productive capacity of those fleets. Another significant advantage is if that J-lay is working in a project in Brazil and then the next project is in Australia, it has to transit from Brazil to Australia. So therefore, in transit, of course, it's not working and therefore not generating revenues. So therefore, the geographic spread of the assets is really important also. So to the extent that you have assets and therefore can optimize what the capability is, the geography in which they operate, that really means that you can deliver with the same pieces of equipment more service to the industry. So you can do more installation. And you could do that more cost effectively because you're not wasting time on transiting and you've got the optimal piece of equipment. So there's 350 million of cost synergies in the proposed combination is what they're guiding for. But more importantly are the revenue opportunities in terms of optimizing the fleet, both from a geographic point of view and a capability point of view. And that's true not only for the offshore oil and gas business, but it's also true for the offshore wind business. Both companies are participants in that market, have been for an extended amount of time. And so the combination of those two things, and this is an interesting business, right? Because the last number of years there's been a consolidation in this business. And the reason for that is not of course, today, a number of offshore wind projects that were on the books have been canceled and aren't happening. So therefore, the demand has slowed down in certain geographies. But more importantly, the aggressiveness and the newness of the business 5 years ago meant that people were bidding contracts at prices that were inappropriate. So for example, if you were operating a project off Taiwan and you figured you'd have how many down days for weather, turns out there's actually much more difficult weather than one might think in Taiwan, and therefore the days you work are substantially fewer than the days you had budgeted. So therefore the process, because they were cutting their teeth and learning how to do this business 4 or 5 years ago, a number of contracts were poorly bid. That process started adjusting 3 years ago. And so again, we think the bad contract business has really largely worked its way through. And therefore the environment today is very different, and therefore the pricing is different. But more importantly, we really do think that there's a substantial growth over time that, and substantial meaning a multiple in time. So therefore, this is a growth business that could generate significant returns to the combined business. So on a revenue side, right, the combination of Subsea 7 and Saipem create a company that'll have $21 billion of revenue. This is on a trailing basis of 24. That's almost the same size as Halliburton. And of course, we're not interested in a big company. We're interested in a profitable company. So we do think the combination, more importantly, has between the cost synergies, but even greater, the revenue synergy opportunity, significant enhancements. At the same time, the trend in the business is increasing demand for the limited amount of equipment that both companies already own. There's a substantial difference. So valuation matters. So down below at the bottom, there's the valuation on these companies versus the Technip FMC, it's a U.S. competitor or U.S. traded public competitor, and these other companies. And so there's a substantial difference in valuation. And we don't think the economics justifies anywhere near that differential. So that's part of the valuation opportunity we see in the investment today. What we really see is there's a number of positives to where we think the next 2 to 3 years profitability moves to. Saipem, over the last 10 years, has twice needed to be restructured because of the combination of their land-based business as well as their offshore business, poorly bidding contracts in a competitive environment. And that meant certain contracts, execution wasn't in any way good enough to overcome poor bidding and therefore small margins, limited margins, and therefore needed to be recapped. And so therefore each one of those times, of course, the company has identified what they were doing. They constricted what they did. They adjusted. So we think that on its own, Saipem is in the process of its third restructuring and being much more selective and better execution in bidding, as well as better execution complemented and benefited by the fact that the market has continued to get stronger and therefore utilization has gotten stronger. So Saipem's margins are increasing. At the same time, you see Subsea 7's margins are substantially higher. And so we do think the combination of Subsea and its capabilities in terms of bidding as well as execution with the increased fleet size to be able to execute, we think margins will continue to increase. In the meantime, Subsea 7 in the most recent quarter had EBITDA margins approaching 20%. So we think the backdrop is margins are improving. As I said, since contracts awarded 3 years ago, the ones you're executing today, and the contract backlog continues to improve in terms of profitability, we think that's a natural trend. We think the combination of the two businesses, is further reason, as well as Saipem's own restructuring. So we think that there's substantial opportunity for EBITDA margin and EBIT expansion, and of course, free cash flow, right? Because every incremental dollar of EBITDA doesn't change the D, the A, does change the T, but not the I. And therefore, the free cash flow generation is even further enhanced as you move margins up. And we think there's significant opportunity. Another opportunity for enhancement on cash returns and margins is the onshore business had been extremely competitive. And that was an area where Saipem had definitely execution problems over the last 10 years. Again, had resized the business, substantially reduced what they did, would change the bidding process to much more being cost plus and not fixed price contracts. And so here it's 26% of their revenue. It's a quarter of their revenue, and it's almost no EBITDA, no cash contribution that comes from the business. We think on its own right, that business continues to improve and ends up being one that can make substantial contributions. In addition, the onshore engineering and construction frequently ties into the offshore piece. So if you have an offshore LNG project, you may have an onshore LNG facility that you need to do to tie into that. So therefore, the Saipem's business is one that can do both of those things. So we do think it logically ties in. And so we think there's a substantial opportunity for further earnings enhancement here. So merger, of course, a critical piece. How do you execute it? How do you bring the companies together? And here you have a company, it's a 50-50 merger. And so, every such merger would have risks associated with it, especially since in this area, the one that people are most aware of is the combination of Technip, a French listed company headquartered in Paris, with FMC, a US listed company headquartered in Texas. So that combination was one that did not go seamless. Definitely at the parent level, there were many problems and adjustments that came from that combination. So yes, you put together two businesses that had commercial logic to it. However, the people part of it wasn't as seamless and wasn't wasn't optimal. Here, we actually think that the reasons to believe that this will work extremely well. First one is you do have a control shareholder in Christian Siem, owns 25% of one of the two companies who will be involved of the new company, and he has also, this is probably the second or third trip to the altar. These two companies over the years many times have considered merging and combining before, so they've thought through the process and they've therefore had scenarios that didn't come to play, and I think from each one of those things have learned something about who the other side is, how they think. So both there's a better understanding. In the meantime, the business itself, the largest piece of it will be the SURF and offshore installation business. John Evans, who's this long-standing CEO and a long-standing Subsea 7 employee, will run that business. And so I think that that's a strong structural opportunity. Right, the chairman of Saipem 7, the combined company, will be a Saipem person. So I think there's a lot of reasons to think that and in the meantime, these two companies, whether that's an offshore wind or it's an oil and gas, over the years often have bid together, been awarded contracts on together, have split contracts, or one has been contracted to the other. So they've worked together in the field multiple times in the past too. So there already is a lot of experience between the two companies. So we think that increases the likelihood of a successful combination that executes well. So what you have, the timeline is the intended merger, we think, closes sometime the second half of the year. There's been a number of agreements. And so what it means also, Subsea 7 today has a market cap of $6 billion. There's $1 billion approximately in distributions, and 3 different distributions that will be made between now and the closing of the transaction to Subsea 7. So there's a substantial cash return even before the deal closes. And so to highlight, this is an industry that is vastly different than where it was 30 years ago. There are a limited number of competitors. The competitors who now are in that space have capabilities far beyond what the individual companies were before. And in the meantime, those capabilities are critical to the oil and gas companies because they have lost the capability to do many of these things. So therefore, the role that they play and the value add is dramatic. And therefore, that makes them in a very different position than you were before. The combination, of course, of the 2 largest fleets give all kinds of opportunities for revenue enhancement, execution capabilities, right? The ability to execute contracts in more places, more contracts better than what in each individual company could have done, given the nature of the assets they have. And again, barrier to entry, it's not just how they design the field and the engineering capability. It's then how do you execute and install in 3,000 feet of water all the subsea surface equipment and billion-dollar contracts, and what's your backlog and the execution you've done on that. Those are huge barriers. So what you have is a business with a limited number of competitors, with dramatic capabilities, and a real barrier to entry into the business. And so the high level, it's led by an owner operator. Christian Siem is an integral part of why we're excited about the opportunity. It's a differentiated company today with visible and hidden barriers. The hidden barriers being the people part of it, and that's the people who can engineer and design the field, and the people who can execute the installation with using those vessels, and including capabilities. There's 6 the reel lay facilities they have onshore where they reel the pipe and then bring it to offshore to install it. Huge advantage. There's technology they have. So there are many things that each one of these companies have that differentiate them. The merger with Saipem, we think, is the latest transformational thing to really substantially change the opportunity set and the capabilities of Subsea 7. It undoubtedly will bring incremental pricing power and flexibility on how to use the equipment and where to use it. There's a $1 billion distribution on a $6 billion market cap between now and the time the deal closes. And as we mentioned earlier, the addressable market has dramatically increased with the growing importance of LNG, the increasing amount of tiebacks that can be done, the new geographies in which the companies operate today and discoveries are being made, as well as the old geographies that get reactivated. There's 3 or 4 or 5 markets around the world that have substantial resource that are in the latency period today for a multitude of reasons. Part of that is economics, and those countries almost universally are interested in higher production because it's a critical part of their economics. And so therefore we think that in the next number of years, countries like Mexico, Nigeria, who are historically strong producers, are likely to be very active in this business and therefore reactivate the businesses in those geographies too. So John, that's the basic concept.